Welcome back to the deep dive. It is Wednesday, February 25th, 2026. And I just have to say, looking at the markets right now, the energy out there feels electric.
Absolutely. Electric, or maybe manic is the better word for it.
Yeah, manic definitely fits. It really feels like we're looking at a landscape that is just completely different than it was even, 2 years ago.
It certainly does. I mean, the dust has finally settled from that initial AI explosion we saw back in 2023 and 2024.
Right, the hype cycle.
Exactly, the hype cycle. And now we are actually living inside the structure that explosion built.
Mm-hmm.
It's less about the wow factor of a chatbot writing a poem for you, and it's much more about the industrial grade reality of who actually owns the infrastructure of the world right now.
Yeah, and today, for this deep dive, we are tackling the absolute juggernaut of that infrastructure, the elephant in the room.
Or maybe the T-Rex in the server.
The T-Rex in the server room, I like that. We are, of course, talking about NVIDIA, ticker symbol NVDA.
It's the topic everybody has been requesting, and honestly, it's the one we couldn't avoid even if we wanted to. You literally cannot talk about the global economy in 2026 without talking about this specific company.
No, you really can't. But I want to be incredibly clear right off the bat for everyone listening. We are not just talking about a quote-unquote chip company today.
Far from that.
The sources we have in front of us, and we have a really massive stack of documents here to go through, they are calling this company the foundational architect of the global AI factory.
Yeah, that is a very heavy title.
It is. It sounds like something straight out of a sci-fi novel, the foundational architect.
It does sound like sci-fi. But when you look at the raw numbers we have from the close of fiscal year 2026, it's a title they have arguably earned. We're looking at revenue figures that, honestly, they sound like the GDP of a small to mid-sized European country.
It's just totally detached from normal reality.
Right. We aren't dealing with normal corporate metrics anymore.
Yeah.
We are dealing with nation-state level economics here.
It is genuinely mind-bending. But before we get lost in the billions and the trillions today, and believe me, we're going to get very lost in them, we have a specific mission for this deep dive.
We do.
We are going to track the market temperature of this absolute beast, because despite these massive numbers, there is a huge debate raging right now. Is this a bubble? Or is this literally just the beginning?
That is the trillion-dollar question.
Literally. And speaking of tracking market temperature, if you want to do that yourself right from your phone, I want to take a second to mention something really cool. To track the total market temperature, you are welcome to search and download the iOS app Buffett Indicator. It's available right now on the Apple App Store.
Yeah, it's a fantastic tool. It'll give you that macro view, right? The total market cap versus GDP. It really helps you see if the water you're currently swimming in is, boiling or freezing.
Exactly. It is a fantastic reality check when things get as crazy as they are right now. And for those of you who really want to go down the rabbit hole, our contrarian friends out there who are listening and want to see exactly what the algorithms are seeing, if you want to access more advanced contents, welcome to subscribe on deepvalues.ai.
Highly recommended.
Yeah, that is where we will share our latest researches and the most advanced AI agent tools for our contrarian friends. So definitely check that out. And hey, don't forget to like this video or podcast wherever you're listening. Much appreciated. It really helps us out.
Definitely.
Okay, now, before we unleash the actual analysis, we have to handle the housekeeping.
Right, the mandatory disclaimer. Please listen closely, everyone. All analysis discussed today is based on publicly available sources and may be subject to revisions or different interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Perfect. Legalities are handled. So let's unpack this massive stack of paper.
Let's do it.
Our mission today is to parse through what is frankly a very conflicting set of documents. On one hand, we have an institutional equity research report from Q4 of fiscal year 2026, and it is basically popping champagne bottles.
Oh, it's incredibly bullish.
It reads like a victory lap. But then, on the other hand, we have a separate report generated by the Deep Value Intelligence System, that's the AI-powered multi-agent framework, and it is actively waving a yellow flag.
In fact, it's waving a yellow flag and blowing a whistle at the exact same time.
Right, and that is the central tension of the current market that we need to figure out for you guys today. We are looking at a company with record-breaking, literally history-making performance.
Unprecedented.
Unprecedented execution. Nobody denies that. But the investment analysis is split completely wide open. One side says advocate, which basically means buy with both hands, leverage up, and do not look back.
And the other side says avoid, or at best, wait.
And that's what is so incredibly confusing for a normal person looking at this. How can a company doing this well, executing this perfectly, be an avoid? Usually that avoid label is reserved for companies that are, bleeding money, or they have a CEO under federal indictment. NVIDIA is just printing money.
It's because we have crossed a threshold. As the sources highlight, we have officially left the hype phase.
Okay, explain that.
The hype phase was the Wild West of 2023 and 2024. Everybody was just throwing money at anything with AI in the name. But now we are deep into what the sources call the proof of value phase.
Proof of value.
Right. The question for 2026 is no longer, is AI cool? Or can it pass the bar exam? The market doesn't care about that anymore. The question is it actually making money for the people who are buying the chips? The market is finally demanding a receipt.
Ah, okay. That makes a lot of sense. So let's look at the actual industrial revolution happening right now on the ground. That is the exact phrase the institutional report uses, by the way. Quote, a structural break from the traditional computing era, end quote.
It sounds dramatic, but it's accurate.
But what does it actually mean, practically speaking?
Okay, think about the original Industrial Revolution back in the 19th century. We moved from manual human labor to steam power and mechanization. This report argues we are seeing the exact same structural shift, but in the realm of information.
From manual to mechanized information.
Exactly. For the last 30 years, we lived in an era of retrieval. You type a query into Google, and the computer searches a database and fetches a pre-existing document for you.
Right. It's basically a really fast digital librarian.
Precisely. But now we are moving to an era of generation. The computer isn't just fetching a document. It is thinking, synthesizing, and creating the answer on the fly. And to do that, to generate rather than retrieve, you cannot use the old computers. They aren't built for it. You need a completely new type of factory.
And NVIDIA basically owns the factory floor.
They don't just own the floor. They built the building, poured the concrete, and hold the patents on the machines inside it.
Okay, let's talk about the numbers that actually prove this, because we just saw the Q4 fiscal year 2026 numbers come in, and I want everyone listening to brace themselves. Revenue hit $68.1 billion.
And we need to emphasize, that is just for one quarter.
I really want to pause on that for a second so it sinks in. $68.1 billion in 3 months. Let's put some context around that. That is more money than Intel, AMD, and Qualcomm used to make combined in an entire good year back in the day.
It's completely staggering. That $68 billion represents a 73% increase year over year.
73%.
And you have to remember, last year's numbers were already considered astronomical. Everyone on Wall Street thought, okay, surely they cannot double again. The law of large numbers has to kick in eventually.
Right. You can't keep crowing like a startup when you're the biggest company in the world.
Exactly. And yet they nearly did it again. Wall Street was expecting around $65 billion for the quarter, which was already an incredibly aggressive, almost euphoric target. And NVIDIA just blew past it by $3 billion, like it was absolute nothing.
It's the scale of the beat that gets me. A 73% jump on a base that large involves moving an incomprehensible amount of money through the global financial system. We aren't talking about some sauce startup going from 1 million to 2 million in ARR. We are talking about moving the equivalent of a national economy.
It really is. And what's critical to understand here, and the institutional report makes this very, very clear, is that NVIDIA has successfully transitioned its entire corporate identity.
How so?
Well, if you are listening to this and you still think of NVIDIA as the company that makes the cool graphics card for your gaming PC so you can play Call of Duty at high frame rates, you are looking at a ghost. That company does not exist anymore.
Wait, they aren't a gaming company at all anymore.
Not really, no. They are a full-stack ecosystem provider. They sell the custom silicon, the networking systems, and the enterprise software. They're a utility company now.
Okay, let's break down where that $68 billion is actually coming from, because the revenue mix has changed completely over the last few years. I'm looking at the revenue breakdown table from the Q4 report right now. Data center revenue is now, it is 88.27% of the entire business.
Almost 90% of their revenue is just selling into data centers. It is the dominant engine. In fact, it's really the only engine that matters to their stock price anymore.
But compare that to the gaming segment. I mean, I remember the green eye logo on all the PC game loading screens growing up, the way it's meant to be played. That was their whole identity in the 2000s and 2010s.
It absolutely was. Now, gaming is sitting at just 8.7% of the revenue pie.
That's wild. It's totally eclipsed.
It is shrinking. Now, to be fair, it's not necessarily shrinking in absolute dollars. Gamers are still out there buying high-end RTX cards. But relatively speaking, compared to the absolute monster that is the data center segment, gaming is becoming a niche. It's almost like a side hobby for the executives at this point.
A very lucrative side hobby, but a side hobby nonetheless. And looking at the other segments on this table, professional visualization, automotive, they are incredibly tiny. Automotive is sitting at just 1.3% of revenue.
Yeah, that surprises a lot of people.
It surprises me. I thought self-driving cars and autonomous vehicle brains were going to be the next massive leg of growth for them.
And they might be eventually, but right now, compared to the insatiable black hole level hunger of the AI data centers, the entire global auto industry is just a rounding error on NVIDIA's balance sheet.
A rounding error?
Literally. So when we talk about NVIDIA in 2026, we are effectively analyzing a monopoly utility provider for the global intelligence economy. That is the only lens that matters.
They are the electric company, the water company, and the steel mill for the AI age, all rolled into one single stock.
Precisely. If you want to build an AI application anywhere on Earth, you essentially have to pay a toll to plug into their grid.
Okay, so who are the actual customers keeping the lights on at this giant factory? Because it's obviously not you and me buying a single card at Best Buy anymore. It's the hyperscalers, right?
Yes. The big four, Amazon, Google, Meta, and Microsoft. The customer concentration here is something you rarely see in a company this large.
How concentrated are we talking?
Well, the sources project that these specific companies, collectively, are going to spend between $650 billion and $700 billion in AI-related capital expenditures, CapEx, in 2026 alone.
I'm sorry, I need to stop you. $700 billion.
Yes.
That is an incomprehensible amount of money for corporate capital expenditures in a single year. Where is that money actually physically going?
It's going into the physical earth. It's going into pouring concrete for massive new facilities. It's going into building dedicated power plants just to run the servers. And mostly, it's going directly into NVIDIA's pockets.
It's basically a Cold War arms race, isn't it?
It is exactly an arms race.
Yeah.
Microsoft is absolutely terrified that Google will get to AGI, artificial general intelligence, first. Google is terrified that Meta's open source models will destroy their search monopoly. So they're all spending every single available dollar they have to stockpile weapons.
And NVIDIA is the primary arms dealer sitting in the middle selling to everyone.
Exactly. And they are the only arms dealer that has the good stuff.
But here is a really interesting nuance I noticed from the institutional report regarding the units they're selling. In the old days, analysts just counted chips, right? Like, how many individual GPUs did NVIDIA sell this quarter?
Right. It was a pure volume game of discrete components.
But now the unit of measurement has fundamentally changed. They aren't just selling loose chips anymore. They are selling what the report calls AI racks and DGX pods. It says they are projected to ship nearly 30,000 AI racks this year.
Can you paint a picture for me? What exactly is an AI rack?
Sure. Imagine a standard server rack you'd see in any IT closet. It's roughly the size of a large kitchen refrigerator. But inside this specific rack, it's not just a bunch of loose, independent computers stacked on top of each other. It is a tightly integrated single supercomputer.
Okay.
We're talking about the GB200 NVL72 racks. These things are absolute beasts. They consume 120 kilowatts of power per single rack.
120 kilowatts. Wait, for one rack, that's like powering a whole neighborhood of houses.
It is. And because they draw so much power, they create an incredible amount of physical heat. You can't just put a fan on them and blow cold air down the aisle anymore, or the silicon would literally melt into slag. They have to be entirely liquid-cooled, plumbed with coolant like a car engine.
And because of all that integration, these racks cost millions of dollars each. Millions for one refrigerator-sized box.
So they've completely moved up the food chain. Instead of just selling you the engine block, they are now selling you the entire luxury car, the tires, and maybe the road it drives onto.
Exactly. And what that does is it massively increases their quote-unquote share of wallet.
Share of wallet.
Yeah, they aren't just getting the margin on the silicon chip anymore. They are getting the margin on the high-speed networking cables, the networking switches, the specialized cooling manifolds, the software integration. They capture the profit from the entire stack.
That sounds like an incredibly secure position to be in financially. But let's talk about the defense for a second. Every castle needs a moat. And in the traditional tech hardware world, hardware is usually a terrible moat.
Historically, yes, it's a race to the bottom.
Right. Someone in Taiwan or South Korea always figures out how to reverse engineer the circuit board and make it 20% cheaper. We've seen it with memory chips. We've seen it with solar panels, flat screen TVs. Why hasn't that happened here? Why can't AMD or Intel just build a cheaper, faster chip and steal the hyperscaler market?
That is the trillion-dollar question that every bear asks. And the answer, according to the sources we're reviewing, is what they call the toll bridge moat. And the crucial thing to understand is the toll bridge isn't actually made of silicon. It's made of software.
Software.
Specifically, a software platform called CUDA.
CUDA.
Okay, we hear this acronym constantly when talking about NVIDIA. Let's really unpack it for the non-engineers listening. Is this software really that special?
Think of CUDA as the foundational operating system for accelerated computing. NVIDIA launched this platform way back in 2006, over 15 years ago, back when everyone else in the industry was completely asleep at the wheel, thinking GPUs were only good for rendering video game graphics.
They saw the parallel processing potential way before anyone else. Exactly. And over those 15-plus years, millions of software engineers, AI researchers, and grad students learned to code their neural networks using CUA. All the major AI frameworks, things like PyTorch or TensorFlow, were optimized to run on CUD first and foremost.
So it's like learning a language.
It is exactly like learning a language.
Yeah.
Imagine you run a massive international business. All of your thousands of employees speak fluent French. All your legal contracts are written in French. All your factory instruction manuals are in French.
Okay, I'm with you.
Then a competitor comes along and says, hey, I built a fantastic, shiny new office building down the street. It's 20% cheaper to rent than your current building, and the elevators are a bit faster.
Sounds like a good deal.
But there's a catch. To work in my new building, all of your employees have to immediately stop speaking French and learn to speak Esperanto. Are you going to move your company?
No way! The sheer cost of retraining everyone, translating all the millions of documents, the downtime, it would completely bankrupt me.
That is the concept of switching costs. And right now, in the AI hardware space, the switching cost away from CUD is prohibitively high. The Deep Value report we're looking at specifically describes this as a wide and besieged moat.
Wide and besieged. I like that specific imagery. It sounds very medieval.
It's a great metaphor.
Mm-hmm.
It means the moat, the CUD Guy software lock-in, is incredibly wide right now. It's very, very hard for a customer to swim across it to a competitor. But because the profits inside the castle are so insanely high, and we will get to those profit margins in a minute, everybody is currently besieging the castle.
Because there's so much treasure inside.
Exactly. You have Google spending billions building their own custom TPUs. You have Amazon building their Trainium chips. They're building rafts. They're digging tunnels. They are trying to find any possible way around that CUDA moat so they don't have to pay NVIDIA's toll.
Right, but I have to play devil's advocate here for a second. If the toll is so painfully high and NVIDIA is charging such an insane premium for these racks, won't Amazon eventually just force their engineers to learn Esperanto? I mean, if you're spending $700 billion collectively, you can pay for a lot of corporate language lessons.
That is the ultimate long-term threat, yes. The moat is not infinite. Software moats rarely are forever. But for 2026, the problem is speed. That toll bridge is currently the only reliable way to get your AI products to market fast enough. If you stop everything to build your own bridge from scratch, you lose the AI arms race entirely. And none of the hyperscalers can afford to lose.
So speed is the ultimate lock-in right now.
Speed is the lock-in. Fear of missing out is the glue holding it together.
Wow. Okay, speaking of new people trying to cross that bridge, there is a totally fascinating new customer tier mentioned in both of the 2026 reports. It's not just tech companies buying these chips anymore, it's entire nations. The report calls it sovereign AI.
Yes, this is a major structural shift that really started gaining traction in late 2024 and absolutely exploded into 2025.
What's driving it?
Countries have woken up and realized that artificial intelligence is no longer just a cool tech sector. It is a matter of fundamental national security. They look at the landscape, and they do not want their citizens' private data or their government secrets or even their cultural heritage residing in a cloud owned by a U.S. corporation sitting on physical servers in Virginia or Oregon.
They want data sovereignty.
Exactly.
Yeah.
They want their own native AI factories located physically within their own borders and subject to their own sovereign laws. The report highlights Japan and Vietnam specifically as nations that are investing heavily right now in domestic AI infrastructure.
So they're just buying directly from NVIDIA.
Yes. They're buying thousands of NVIDIA racks to build state-owned or state-sponsored supercomputing clusters.
That sounds incredibly bullish. I mean, it sounds like a whole new massive market opening up. And a government contract is usually the holy grail of stability for a corporation, right? But I noticed the Deep Value report, the skeptical AI report we have, it actively flags the sovereign AI trend as a major risk. Why? Why is selling billions to a country risky? Governments usually have very deep pockets and they pay their bills.
They do have deep pockets, but they are also incredibly fickle. And more importantly, they are subject to geopolitics. The Deep Value analyst flags this specifically as political risk.
Explain that for me. How does that impact the stock?
Look at the high fence, small yard policy that the U.S. government implemented a few years ago. We have already seen this play out extensively with China. The U.S. government can literally overnight decide that a certain country is no longer allowed to buy these high-end AI chips because they might theoretically be used for military modernization.
Right, export controls.
Exactly. So imagine NVIDIA spends 2 years negotiating a $5 billion contract with a sovereign nation in, say, the Middle East or Southeast Asia. They build the racks, they prep the shipment, and then Washington decides that country is now on the naughty list.
The Commerce Department just steps in.
They step in, and that $5 billion in revenue vanishes instantly. Poof, gone.
It's not a market force at all.
Not at all. It is a pure political force. You cannot model it on an Excel spreadsheet. If you're an investor banking on $50 billion in sovereign revenue over the next 3 years, and a political decision in Washington shuts that market down, NVIDIA's earnings will miss expectations significantly.
That adds a massive layer of complexity that just doesn't exist when you're just selling to, Microsoft or Meta. Microsoft isn't going to get sanctioned by the U.S. government.
Exactly. The rules of engagement are totally different with sovereign states.
Okay, so we have the macro landscape pretty well defined here. We've got huge revenue growth, a massive structural shift in computing, and this new sovereign AI pipeline coming online. Now we have to talk about the actual price tag of the company, because this is where the real fight breaks out between our two sources, the valuation debate.
Ah, yes.
And I want to get deep into the weeds here because this is exactly where retail listeners end up losing money if they aren't incredibly careful.
This is the ultimate bull versus bear cage match of our era.
Right. So in the bull corner, we have the growth investor perspective. The institutional report explicitly references the investment styles of legends like Peter Lynch and Stanley Druckenmiller, and their basic argument seems completely counterintuitive at first glance. They're essentially saying, quote, the stock looks wildly expensive, but it's actually cheap.
It sounds like a paradox.
It does. How does that math actually work? Because if you look at a 5-year chart of NVIDIA's stock price, it literally looks like a vertical line pointing straight to the moon.
It does look vertical. But the growth argument relies almost entirely on a specific metric, the PEG ratio, PEG, which stands for the price to earnings to growth ratio.
Okay, let's unpack the PEG ratio for the 5th graders in the room, which definitely includes me sometimes when the math gets this big.
Sure. So everyone listening probably knows the standard PE ratio, price divided by earnings.
Right.
A PE of 20 simply means you are paying $20 for every $1 of corporate earnings. A PE of 40 looks exactly twice as expensive.
Makes total sense.
But the PE ratio is just a static snapshot in time. It doesn't tell you how fast the car is moving. If you have a legacy bank growing its revenue at 2% a year and it has a PE of 20, that might actually be really expensive.
Because it's barely growing.
Exactly. But if you have a hyper-growth tech company doubling its revenue at 100% a year and it has a PE of 40, well, is that expensive? That's where the PEG ratio comes in. You take the PE multiple and you divide it by the earnings growth rate.
It adjusts the price for the speed.
Exactly. It contextualizes the multiple. And what is the general rule of thumb for investors using PEG?
Usually anything under a 1.0 is considered quote-unquote cheap or undervalued, right?
Correct. A PEG under 1 suggests that the company's earnings growth rate is actually higher than its PE multiple.
Okay, so where is NVIDIA sitting right now in February 2026?
Well, depending on the specific metric you pull from the source documents, whether you are using trailing 12-month earnings or forward projected earnings, NVIDIA's PEG ratio is sitting somewhere between 0.52 and 0.79.
Wait, hold on. 0.52.
Yes.
That is, for a mega cap tech stock, that is incredibly low. That suggests it's essentially a bargain basement cheap relative to its growth.
It is historic.
Yeah.
It mathematically suggests that despite the stock price climbing vertically to these all-time record highs, the actual net income earnings of the company have grown even faster than the stock price did.
That's crazy.
The growth analyst in the report calls this the earnings catch-up. Let's say the stock price went up 200% in a year, which sounds like a bubble. But if the actual bottom line net income went up 300% in that same year.
Then the stock effectively got cheaper while it was going up.
Exactly. The valuation multiple actually compressed because the fundamentals outran the hype. That is the bull case in an absolute nutshell. Don't look at the sticker price of the stock, look at the speed of the earnings engine.
Okay, that makes sense. What else are the bulls pointing to?
They also point heavily to the rule of 40. This is a metric that is very often used by venture capitalists to evaluate software companies trying to balance their growth rate with their financial health.
How do you calculate it?
It's very simple. You take the revenue growth rate percentage and you add the profit margin percentage. If the combined total is over 40, you have a very healthy, thriving business.
Okay, and where does NVIDIA score on the rule of 40?
NVIDIA's score right now is roughly 137.
137 on a rule of 40.
Yes. It is elite tier. It is almost completely off the standard charts. Usually in the real world, you see software companies with incredibly high growth, but zero profit margin because they're burning cash. Or you see legacy companies with high profit margins, but very low growth.
Right, it's usually a trade-off.
But NVIDIA breaks the standard financial models. They have massive triple-digit growth and massive double-digit margins simultaneously.
And what about the technical traders? Do they like the setup?
The report notes that technically the stock looks very healthy. It is currently trading well above its 200-day simple moving average, which is sitting as a strong support base at $173.94. And the relative strength index, the RSI, is sitting right at 58.16.
Which means it's not technically overbought yet?
Correct. It has technical room to run higher before it overheats. That's the complete bull case. Everything is firing on all cylinders, the growth is unprecedented, and the valuation metrics haven't actually caught up to the new reality of the earnings power.
Okay, honestly, that sounds incredibly convincing. I'm almost ready to open my brokerage app right now. But wait, I can see the value investor, the Warren Buffett style persona in the Deep Value report, just aggressively shaking their head in the corner. Why? What are the value guys seeing that the growth guys are completely missing?
The safe analyst, or the Buffett-style persona in the AI report, looks at this exact same data completely differently. They operate using a series of strict investment gates, or safety tests, and they argue that NVIDIA fails the very first gate, the predictability test.
The predictability test, is that just a fancy way of saying, can you predict the future? Because if so, nobody passes that test.
Well, it's a bit more specific than that. The test is, can you predict with high confidence what the specific industry landscape will look like in exactly 10 years?
Okay.
If you look at a classic Buffett stock like Coca-Cola, you know with near absolute certainty that human beings will still be drinking carbonated sugar water in 2036. The fundamental technology of putting liquid in a bottle hasn't changed much in a century. The cash flows are highly predictable.
True. It's a very stable business model.
But if you look at NVIDIA and the semiconductor landscape,
Yeah.
can you tell me with high confidence what the dominant computing architecture will be in 2036?
I have no idea.
Nobody does. Will we even still be using traditional GPUs? Will quantum computing have taken over the data center? Will Google and Amazon have successfully moved entirely to their own proprietary in-house silicon? Will some crazy new biology-based neural computing be a thing?
The tech industry basically reinvents itself from the ground up every 5 to 7 years.
Exactly. It is what the report calls a hard game. Innovation is incredibly rapid, and rapid innovation is fantastic for us as consumers. We get amazing new phones and apps, but it is absolutely terrible for the kind of long-term financial predictability that deep value investors crave. They want a sure thing. And NVIDIA, by the very nature of its fast-moving industry, is not a sure thing over a 10-year horizon.
That makes total sense. And then reading further into the bear case here, there is the price-to-book ratio. I saw the specific number in the Deep Value report, and I actually gasped out loud. 50 times.
Yes. The stock trades at nearly 50 times its book value.
Let's make sure everyone listening understands the true gravity of that metric. Book value is basically the literal physical value of your factories, your unsold inventory, your cash in the bank. It's your tangible stuff, right?
Right. If you theoretically bankrupted and liquidated the company today, if you sold every office building, auctioned off every server, sold every patent, the cash you would have left over is the book value. And right now, the stock market is paying $50 for every $1 of that tangible stuff.
So you are basically paying $49 for pure air, or, well, sentiment and future hopes.
You are paying entirely for future earnings that have not actually happened yet. The expert analysis in the report has a great phrase for this. They call it a total absence of a physical floor.
A total absence of a physical floor.
Think about it. If the market sentiment suddenly shifts, if investors wake up tomorrow and decide they don't believe in the AI narrative anymore, there is no underlying physical asset base to catch the falling stock price. The stock could theoretically drop 80% in a panic, and at 10 times book value, value investors would still consider it expensive.
That is legitimately terrifying if you're holding a large position. But wait, the bulls would counter that, wouldn't they? They'd argue that for a modern software and chip design company, physical book value is a useless metric because all their real value is in their intellectual property and their engineering talent, right?
That is the standard counterargument, yes. But the bears point out that NVIDIA is increasingly becoming a massive hardware company again. They have physical inventory. They have complex physical supply chains for these massive racks. And paying a 50x multiple for a hardware-heavy business is completely historically unprecedented.
Okay, I see the risk there. And then the report brings up something called the quality trap. This is a concept I had honestly never heard before reading this source. Explain this to me. How on earth can quality be a trap for an investor? Usually, we are desperate for high-quality companies.
It's a fascinating economic concept. We mentioned earlier that NVIDIA has roughly 56% net margins.
Yeah.
Meaning for every single dollar they take in from a customer, they keep 56 cents as pure bottom-line profit.
Which sounds absolutely incredible.
It is incredible. It is a sign of an unbelievably high-quality business operation.
So where is the trap?
The value investor argues that profit margins that high act as a giant, flashing neon sign for global competition. It's literally like dumping buckets of blood into shark-infested waters.
Ah, okay, I see where this is going.
Capitalism fundamentally hates a vacuum, and it hates excess profit. When every other tech CEO on Earth looks at NVIDIA's earnings and sees them making 56 cents on the dollar, they say, I want a piece of that action. It heavily incentivizes massive companies like Amazon, Google, Intel, and hundreds of well-funded venture startups to spend billions and billions of dollars to attack those specific margins.
So the trap for the retail investor is simply extrapolating the present into the future.
Exactly. The trap is assuming those 56% margins are a permanent law of physics. If free market competition actually works the way it's supposed to, and over a long enough timeline, it almost always does, those astronomical margins will eventually be forced to revert to the historical mean.
Because competitors will offer cheaper alternatives to steal market share.
Right. Let's say over the next 3 years, competition forces NVIDIA to lower prices, and their margins drop from 56% down to, say, 30%. 30% is still a great business. But if margins drop to 30%, their total net earnings effectively drop in half. And if the earnings drop in half, the stock price crashes, even if their overall top-line revenue continues to grow.
Wow. That is a very sober, very dark thought. The very thing that makes them a great company right now, those massive monopoly margins, is the exact thing that mathematically guarantees an army of well-funded enemies is coming to destroy them.
It is the ultimate paradox of corporate success.
So we have this really intense valuation debate. The growth team says it's cheap relative to its incredible speed. The value team says it's wildly expensive relative to economic reality and the laws of capitalism. So let's look inside the company's own wallet to see who might actually be right. Section 4 of our dive, the financial fortress.
This is the one area where both the bulls and the bears have to sit down and agree. The balance sheet of NVIDIA in 2026 is immaculate. It is truly a thing of financial beauty.
Let's talk about cash versus debt, because usually when you see a company growing at 70% a year, they're absolutely drowning corporate debt to fund that expansion, right?
Not NVIDIA. They are currently sitting on a cash pile of $54.1 billion.
$54 billion in cash, just sitting in the bank.
Yes, and that cash position is significantly higher than their total debt load. In fact, their debt-to-equity ratio right now is 0.08.
0.08. That's basically non-existent.
It's entirely negligible. They basically have zero meaningful debt compared to the sheer size of their operations.
And what about the Altman Z-score? I absolutely love this specific metric for deep dives. For those who don't know, it's a formula that predicts the probability of a company going bankrupt within 2 years.
Right, created by Edward Altman. And the score for NVIDIA right now is 78.4.
78.4. Okay, context, please.
For context, any score over a 3.0 is generally considered to be in the safe zone. Any score below 1.8 is the distress zone, meaning bankruptcy is a real risk.
So 3 is safe, and NVIDIA is at 78.
Yes. The expert analysis in the report literally calls this score nearly invincible in terms of traditional bankruptcy risk.
That is hilarious. Nearly invincible.
And their interest coverage ratio backs that up. It's sitting at 401 times.
Meaning what, exactly?
Meaning they could theoretically pay the annual interest expense on their current debt 401 times over, just using their operating income from a single year. They are an impenetrable financial fortress right now.
And here is where I get a little skeptical again, putting on my value hat. They are taking all that fortress wealth and they are pouring it into stock buybacks.
They are. Historically, NVIDIA took every single spare dollar and plowed it aggressively back into research and development. That's how they built the CUE moat in the first place. But in fiscal year 2026, they completely shifted strategy. They returned a record $41.1 billion directly to shareholders through stock buybacks.
$41 billion in buybacks?
And the report notes they still have a massive $58.5 billion authorization remaining in the chamber.
Okay, play the skeptic with me here for a second. Why on earth are they aggressively buying back their own stock when it is trading at absolute all-time historic highs? Usually, a smart management team buys back stock when the market crashes, and they think their company is severely undervalued. If they are spending $40 billion buying at the absolute peak, are they just lighting shareholder money on fire? Or do they know something we don't?
That is precisely the bear argument, that executing massive buybacks at 50 times book value is the definition of long-term capital destruction. They argue that cash should be saved for a rainy day or used for strategic acquisitions.
Right. What's the bull counter-argument?
The bull argument is much simpler. They argue that NVIDIA is currently generating so much free cash flow every single quarter that the management literally does not know what else to do with it. They cannot physically spend it all on R&D, even if they try to hire every engineer on the planet.
So they just give it back to the investors who own the stock.
Right. But there is a much more strategic angle to this that the report highlights. That remaining $58.5 billion authorization is absolutely critical for the listener to understand. You have to think of that authorization as a floor.
A floor, like a safety net under the stock price.
Exactly like a safety net. Let's say the macro market suddenly panics. Maybe inflation spikes, or there's geopolitical news and the NASDAQ Q drops. If NVIDIA's stock price starts to rapidly drop during that panic, say a 10 or 15% correction, the company has $58 billion of firepower ready to deploy.
Oh, I see.
They can step into the open market and buy billions of dollars of their own stock on the way down. That creates massive artificial demand. It supports the price. It acts as a structural stabilizer.
It essentially means the company itself is standing there with a giant catcher's mitt, ready to catch the falling knife so the retail investors don't have to bleed.
That's a great way to visualize it. It reduces the downside volatility.
Okay, that is somewhat comforting if you're holding shares. So summarizing so far, they have infinite money. They have the CUDA software moat, at least for now. But let's pivot to the really crucial part. Section 5, the so what phase. The source material talks extensively about a turning point arriving in February 2026. This is where the rubber actually meets the road for the AI narrative.
Yes. This brings us back to the macro analysis we touched on at the start. For the last 3 full years, 2023, 2024, and 2025, the entire tech world has been stuck in build mode.
Right, building the infrastructure.
Exactly. Buying the physical racks, laying the fiber optic cables, securing the massive power contracts, and training the foundational models. Everybody from Google to small startups was terrified of being left behind, so they bought absolutely everything NVIDIA could produce.
It was pure FOMO spending, fear of missing out.
Massive, unprecedented FOMO spending. But now, as we sit here in 2026, the report notes we are transitioning from build mode to use mode. And this is exactly where the systemic risk lies. The report calls it the CapEx cliff.
The CapEx cliff, that sounds incredibly ominous.
It is the biggest risk in the market right now. The source document includes a quote from an analyst that is quite stark. Quote, "If they don't see a bottom-line productivity explosion soon, their multi-billion-dollar orders will be the first thing cut." End quote.
When they say they're talking about the hyperscalers, Microsoft, Meta, Google.
Yes. Think about it. Imagine a tense boardroom meeting at Google headquarters later this year. The chief financial officer looks across the table at the CEO and says, "Look, we spent $50 billion on NVIDIA hardware over the last 2 years. Where exactly is the $50 billion in new bottom-line profit to justify that spend?"
And if the CEO's answer is, well, our internal chatbot writes slightly better marketing copy now, and our search summaries are a bit faster,
then the CFO is going to slam their fist on the table and say, "Cut the hardware budget immediately. We have enough compute. We need to monetize what we already bought before we buy a single rack more."
And if Microsoft and Google both decide to cut that budget simultaneously?
NVIDIA's entire revenue growth story collapses overnight. Because remember what we discussed earlier, 40 to 50% of their entire revenue comes from just 4 or 5 massive companies. If those 4 companies unilaterally decide we have enough chips for now, the hypergrowth narrative hits a solid brick wall. The stock price would adjust violently.
So for the listener who is heavily invested or thinking about jumping in, we need a solid game plan. We can't just sit here and hope Google keeps spending forever. What exactly should we be watching in the coming quarters of 2026 to see if this CapEx cliff is actually approaching?
The Deep Value Intelligence Report actually provides a fantastic 4-point monitoring plan for exactly this scenario.
Perfect. Let's run through that checklist right now. Item number 1 on the monitoring plan, customer ROI.
This is paramount. Do not just blindly watch NVIDIA's quarterly earnings reports. You have to watch their customers' earnings. You need to read the transcripts for Microsoft's earnings calls. Watch Meta's earnings.
Yeah, what are we listening for?
Are they explicitly, cleanly stating that their AI investments are driving measurable profitability? Or are they hiding those AI costs inside of vague other bets categories? If the hyperscalers are suddenly silent on actual AI profits, you need to be very, very worried about NVIDIA's future orders.
It's a great tip. Okay, item number 2 on the checklist, sovereign AI realization.
We talked heavily about Japan and Vietnam earlier. The question here is that sovereign revenue actually real?
What do you mean real? They announced it.
Announcements are cheap. We need to see the actual cash hitting NVIDIA's bank account. Are these sovereign mega projects actually breaking ground and taking delivery of the rags? Or are they just vague memorandums of understanding and flashy political press releases?
Right. Politicians love a press release.
Exactly. Governments are world famous for grandly announcing billion-dollar infrastructure projects that quietly get canceled 3 years later due to budget constraints. Watch the realization rate.
Makes sense. Okay, item number 3 on the monitoring plan, margin mean reversion.
This goes back to the quality trap we discussed. You must aggressively watch those 56% net margins every single quarter.
Looking for weakness.
Yes. If next quarter they slip to 54% and then the quarter after that they slip again to 51%, that is the trap springing shut.
It proves the bear's right.
It proves that aggressive competition is finally biting them. It means they're actively having to lower their prices to keep customers from fleeing to AMD or custom silicon. If you see sequential margin compression, that is a massive sell signal for the value investor crowd.
And finally, item number 4 on the checklist, Blackwell yields.
Blackwell is NVIDIA's absolute newest bleeding-edge chip architecture rolling out in 2026. And it is incredibly, almost unimaginably complex to physically manufacture.
The physical physics of it are pushing the limits.
Exactly. The key question is, can they actually produce these new chips fast enough to meet the demand? There is a huge backlog of orders. If TSMC, that's their primary manufacturing partner in Taiwan, if TSMC has any production yield issues, or if the advanced packaging process proves too difficult to scale,
then NVIDIA literally can't ship the product, and they miss their revenue targets.
it is a pure supply chain execution risk. Demand doesn't matter if you can't physically build the box.
Okay, we have thoroughly unpacked the macro landscape. We've debated the software moat, the valuation metrics, the financial fortress, and the CapEx risks. It is finally time for Section 6. The final verdicts. The sources were very split on what to do with this stock. Let's summarize the positions and see exactly where we land.
Let's do it. So the fundamentals and growth team, the Peter Lynch crowd, their official verdict is advocate? Yes. They look at NVIDIA and see a classic GARP scenario growth at a reasonable price, or in this case, a wonderful company at a reasonable price. They firmly believe the CUA moat is insurmountable in the near term, the global AI demand is literally just getting started, and they view NVIDIA as the undisputed king of an entirely new technological era.
To them, the massive growth rate completely justifies the premium valuation multiple. They probably think buying NVIDIA today is like buying Apple stock back in 2010 right after the iPhone launched.
Exactly. The runway is years long in their view.
But then we have the deep value Buffett-style team. Their official verdict is avoid.
They do say avoid,
Yeah.
emphatically. They failed the company completely on the 10-year predictability test. They think the current 50x book value price tag requires a full decade of absolute, flawless perfection from management.
And in the hardware tech world, flawless perfection over a decade is basically impossible.
It's vanishingly rare. They see absolute zero margin of safety at these prices. To the value team, buying NVIDIA today is exactly like buying Cisco systems at the absolute peak of the dot-com bubble in the year 2000. Cisco was a truly great company that built the internet, but if you bought it at the top, the price was so terrible it took 20 years to break even.
A great company, but a terrible investment.
Mm.
Okay, so we have advocate and avoid. What about the final synthesis? The Deep Values Intelligence AI system looked at both arguments and came to a final conclusion of wait.
Yes, wait. And I think this is the most highly nuanced stance of the three, and probably the wisest path for the average listener trying to navigate this volatility.
Explain the wait thesis.
Wait does not mean ignore the company. And if you hold it, it doesn't necessarily mean panic sell everything. It simply means wait for a significantly better pitch.
I really like that classic baseball analogy. You are standing at the plate, but you don't have to swing at every single ball the pitcher throws. There are no called strikes in the game of investing. You can just stand there with your bat on your shoulder for years.
Exactly. The synthesis report highly suggests waiting for a market price that actually offers a true margin of safety.
Give me a specific target.
For example, if the broader market corrects or there's a sector rotation and NVIDIA's forward PE multiple organically drops below 25x, that would be a much better pitch to swing at. Or strategically wait for the inevitable period of disillusionment.
The period of disillusionment, it sounds very poetic, but I imagine it's incredibly painful for the people holding the stock.
It's always painful. But it always happens with every major technology shift. Eventually, there will be a catalyst. Maybe it's a massive regulatory fine from the EU, or a sudden geopolitical scare regarding Taiwan, or just a bad quarter where they, quote-unquote, only grow revenue by 40% instead of 70%.
Right, a slight miss against impossible expectations.
When that happens, the media narrative will aggressively shift overnight from AI is God to AI is totally overhyped. Retail investors will panic, and the stock will likely drop 30 or 40% in a matter of weeks.
And that blood in the streets moment, that is when the true value investor finally strikes.
Precisely. You don't chase the FOMO on the way up. You stalk the prey, you build your cash position, and you wait patiently for the market to hand you a temporary discount.
So the takeaway is discipline. This has been a truly incredible deep dive today. We have gone all the way from unpacking a $68 billion revenue quarter to debating the core philosophy of value investing. To wrap this all up, what is the single biggest takeaway for our listener today?
The ultimate takeaway here is recognizing that it is entirely possible for a specific corporation to be a quote-unquote gold standard business operation, but simultaneously be a lead standard investment if the entry price is fundamentally wrong.
That's a great way to put it.
NVIDIA is a spectacular generational company. It might literally be the best executing business in the world right now. But the stock price is a completely different animal than the company itself. As an investor, you must mentally separate the raw business execution from the hysterical market expectations.
That is a crucial, crucial distinction to internalize. Just because the product they make is world-changing doesn't magically mean the stock is a smart buy at any arbitrary price the market demands.
Exactly. Price always matters.
Price always matters. And here's a final provocative thought for everyone to chew on as we close out. The sources repeatedly mention that NVIDIA is essentially becoming the fundamental substrate of the new intelligence economy. Like they are the digital silicon itself, or the new electricity.
Right.
If that premise is actually true, does traditional corporate valuation even apply here anymore? Or are we collectively trying to measure an entirely new kind of global utility, something the human race has literally never seen before, using old rulers from the 20th century?
That is the most dangerous question in finance. Because historically, every single time someone stood up and said, hey, the old rules of valuation don't apply anymore, it's a new paradigm, they usually lost a catastrophic amount of money very shortly after.
True, the dot-com bubble is proof of that.
But on the other hand, looking at the sheer terrifying capability of these new generative AI machines, the underlying technology really is fundamentally different this time. It is a massive tension that isn't going away anytime soon.
And that exact tension is exactly why we watch the markets every single day. All right, a quick final reminder for everyone. If you want to track exactly where we are in this crazy cycle, if you want to see if the market feels less 1999 or 2010, make sure to check out the Buffett Indicator iOS app on the Apple App Store. It is a fantastic way to keep your head cool when the rest of the market gets irrationally hot.
And for all the deep dive research documents and the advanced AI agent tools we mentioned today, definitely head over and subscribe at deepvalues.ai.
And hey, one last standard reminder for the road. Please conduct your own due diligence. We are just two voices in your headphones. At the end of the day, you are the only one pressing the buy or sell button on your account.
Indeed. Be careful and stay disciplined out there.
Thanks so much for diving deep with us today. We will see you all next time.